Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business. What it does, how it makes money, and what makes it competitively distinct.
Stryker was founded in 1941 by Dr. Homer Stryker, an orthopedic surgeon in Kalamazoo, Michigan, who began designing specialized tools and hospital beds because he couldn't find what he needed commercially.
That origin story, a surgeon solving his own clinical problems, shaped a culture of deep product development rooted in understanding what surgeons actually need inside an operating room.
Stryker operates two broad segments. MedSurg and Neurotechnology covers surgical equipment, endoscopy tools, and neurovascular devices. Orthopedics and Spine covers hip, knee, shoulder, and spinal implants.
The defining strategic move of the modern era came in 2013 when Stryker acquired Mako Surgical for roughly $1,700 per share, a robotic arm system for joint replacement surgery.
Mako has become a powerful competitive moat. When a hospital installs the robotic system, surgeons train extensively on its software and mechanics.
The financial mechanics are attractive.
Organic revenue growth has averaged roughly 9% annually over the past 5 years, driven by procedure volume recovery, Mako robotic placements, and continued expansion in international markets.
Gross margins sit near 65%, reflecting the high value-added nature of precision surgical implants and instruments. Operating margins run around 18% and have been expanding as scale benefits accumulate.
Stryker holds a top 2 market position across most of its product categories. In hip and knee replacement, it competes closely with Zimmer Biomet and Depay Synthes, the Johnson & Johnson orthopedics unit.
The dividend has grown for 32 consecutive years, earning Stryker Dividend Aristocrat status. Given the low payout ratio, the company retains significant capacity to fund acquisitions and capital investments simultaneously.
Kevin Lobo has led Stryker as CEO since 2012. He came from Johnson & Johnson with deep operational experience, and under his tenure, the company has dramatically expanded its robotics and international footprint.
One of Lobo's key moves was the 2020 acquisition of Wright Medical, adding upper extremity orthopedics, shoulders, elbows, and ankles to the portfolio and diversifying beyond the hip and knee core.
Stryker's products are sold in over 75 countries, with Mako robotic systems now deployed in more than 3,000 hospitals globally, a footprint that took over a decade to build and represents a formidable barrier.
Looking at the competitive radar, Stryker scores particularly high on moat strength and growth consistency, though its valuation tends to command a premium that reflects investor confidence in the robotics-driven flywheel.
The surgeon training programs Stryker runs are not just marketing, they are a structural switching cost.
With an aging global population, the demand tailwind for joint replacement procedures is structural and multi-decade. Stryker is positioned at the intersection of that demographic trend and the technology shift toward robotic precision.
That's the company chapter for Stryker. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Stryker reported Q1 2026 revenue of $6.02 billion, up 2.6% year over year. Adjusted EPS came in at $2.60 versus the $2.98 estimate, a 12.8% miss driven by Inari Medical acquisition charges. The stock dropped 1.9% post-earnings. But here is the punchline. 0 analyst sell ratings, 35 buys, and a consensus price target of $4.44.
Stryker Corporation is one of the world's largest medical device companies, headquartered in Kalamazoo, Michigan. Founded in 1941, Stryker operates across 3 segments: MedSurg and Neurotechnology, Orthopedics and Spine, and the growing Mako robotic surgery platform. The company serves hospitals, ambulatory surgery centers, and emergency medical services globally. Stryker completed its acquisition of Inari Medical in 2024, adding endovascular venous disease treatment to its portfolio.
At $120.7 billion in market cap, Stryker trades at 21 times forward earnings. The stock yields 1.09%, beta of 0.93, makes it a near-market correlated defensive growth name. CEO Kevin Lobo has led the company since 2012, one of the longest tenured CEOs in the medical device sector, overseeing the Mako robotic surgery build-out from its early days.
Q1 2026 revenue of $6.02 billion grew 2.6% year-over-year, in line with estimates. The miss was entirely on the earnings line. Adjusted EPS of $2.60 missed the $2.98 estimate by 12.8%, a meaningful shortfall driven by Inari Medical acquisition integration charges and one-time costs. GAAP EPS came in at $1.95.
Gross margin was 63.3%, strong for a diversified medical device company. Operating margin reached 15.5%. Net margin was 12.4% on a GAAP basis. Free cash flow on a trailing 12-month basis was $4.28 billion, healthy relative to the $1.3 billion annual dividend obligation.
The Mako robotic surgery system is the key growth metric investors track. Mako installations have grown over 25% annually for several consecutive years. Each installed Mako robot generates recurring revenue through proprietary implant consumables, creating a razor and blade model where hardware drives long-term recurring implant revenue. The international Mako opportunity is nascent. Penetration in Europe and Asia-Pacific remains far below domestic levels.
Neurotechnology and spine, which includes LifeNet emergency response systems, grew double digits in Q1. LifeNet is used in hospitals and EMS fleets for cardiac care coordination. This segment benefits from structural hospital technology upgrade cycles and aging EMS fleet replacement programs that are budget independent from surgical procedure volumes.
Balance sheet: cash of $2.88 billion against net debt of $11.35 billion. The Inari acquisition added leverage, but Stryker's $4+ billion in annual free cash flow supports rapid deleveraging. Total equity stands at $46.3 billion. FY 2026 EPS consensus estimate is $15 on revenue of $27.3 billion, implying meaningful earnings recovery in the back half of the year as Inari integration charges normalize.
Valuation: trailing PE of 37.1 times reflects the Q1 EPS miss. Forward PE of 21 times is the more relevant metric, embedding the street's expectation that Inari charges normalize. Price to book of 5.4 times and EV to EBITDA of 23.6 times are in line with large-cap medical device peers. The 1.09% dividend yield reflects Stryker's reinvestment-focused capital allocation.
The analyst community is uniformly bullish on Stryker despite the Q1 miss. 35 buy ratings, 13 holds, 0 sells. The average price target of $444 represents 41% upside from the current price of $315. This is one of the most unambiguous buy consensus readings in the S&P 500 medical device space. A zero-sell consensus is rare at a $120 billion company.
The dominant bull thesis: Inari integration charges are temporary. The underlying Stryker business continues to compound. Mako robotic surgery is growing installations over 25% annually, a durable, multi-year growth driver that competitors cannot replicate quickly. Zimmer Biomet has ROSA robotic surgery, but lacks Stryker's installed base and procedure data ecosystem.
Post-earnings commentary from Wall Street focused on the buy-the-dip opportunity. Morgan Stanley maintained overweight, noting the EPS miss was entirely acquisition-related rather than organic business weakness. The key question analysts posed on the earnings call: when do Inari integration charges fully normalize? Management guided for charges to moderate significantly by Q3 2026.
The hold side argument focuses on valuation. 13 hold-rated analysts note that even at 21 times forward earnings, Stryker's premium requires flawless Mako execution and Inari integration. Any further integration surprises or Mako slowdown could compress the multiple toward the high teen range, limiting upside from current levels. The question is whether 41% upside to the average price target is achievable in the 12 to 18-month window.
Institutional positioning indicates the sell-off created buying interest. The aging population structural driver, more total knee and hip replacements as baby boomers age into their late 70s, provides a macro tailwind that is independent of hospital capex cycles. Stryker's Mako enables outpatient robotic joint replacement, a key cost reduction driver for hospital systems managing reimbursement pressure.
The bull case centers on Mako robotic surgery as a winner-take-most platform. Each installed Mako robot locks the hospital into Stryker implants for the life of the robot, typically 7 to 10 years. With over 25% annual installation growth, the installed base compounds and the recurring implant revenue stream grows with it. International Mako penetration in Europe and Asia-Pacific adds a long runway beyond the domestic market.
Inari Medical adds an endovascular growth vector. Venous thromboembolism, blood clots, is a massive addressable market that Inari's FlowTriever device addresses with a differentiated mechanical thrombectomy approach. Stryker's distribution network accelerates Inari's market penetration beyond what Inari could have achieved independently. If Inari reaches its revenue potential, the acquisition economics are transformative at current valuation.
The buy-the-dip narrative is supported by insider behavior and analyst unanimity. 0 sell ratings at this scale of EPS miss is unusual. It signals the street views the miss as technical rather than fundamental. At 41% consensus upside, Stryker offers one of the clearest risk-reward setups in large-cap healthcare.
The bear case starts with integration risk. Stryker has completed multiple large acquisitions, Wright Medical, Vocera, Inari Medical, in a compressed window. Managing integration across multiple simultaneous programs creates execution complexity. The Inari charges that caused Q1's EPS miss are a symptom of this complexity. If Inari integration extends into 2027, the free cash flow profile is constrained longer than the market expects.
Hospital capital expenditure pressure is a structural headwind. Hospitals are managing reimbursement rate pressure from Medicare and Medicaid while navigating post-pandemic staffing cost inflation. Large capital equipment purchases, including Mako robots, require hospital board approval and multi-year budget commitments. A hospital spending slowdown would directly impact Mako installation growth, the primary bull thesis driver.
Net debt of $11.35 billion limits strategic flexibility. With $4 billion in annual free cash flow, Stryker can service the debt comfortably, but it limits additional acquisitions or aggressive buybacks. Competitors Intuitive Surgical and Zimmer Biomet have cleaner balance sheets to pursue emerging medical robotics acquisitions if the market consolidates.
Competitive intensity is rising. Intuitive Surgical's Ion bronchoscopy system and Zimmer Biomet's ROSA platform are encroaching on Stryker's robotic surgery leadership. If Intuitive expands ROSA into orthopedics, its natural clinical adjacency, Mako's competitive moat faces the most formidable challenge in its history.
The medical device peer comparison, Stryker versus Intuitive Surgical and Becton Dickinson. Intuitive Surgical trades at 50-plus times forward earnings, a premium reflecting Da Vinci's dominant market position and recurring instrument revenue. Stryker at 21 times forward is significantly cheaper on earnings, but Intuitive's recurring revenue model is more predictable, justifying part of the premium.
Zimmer Biomet is the direct orthopedic peer. ZBH trades at approximately 15 times forward earnings, a discount to Stryker reflecting Zimmer's slower growth profile and less developed robotic surgery platform. Stryker's Mako premium over Zimmer is approximately 6 times forward earnings, investors paying for the faster-growing, more disruptive robotic platform.
Becton Dickinson is the conglomerate medical device comparison. BD trades at 14 times forward earnings on a complex multi-segment portfolio that includes diagnostics, biosciences, and medication management. Stryker's premium to BD reflects its higher organic growth rate and the Mako robotics optionality.
Edwards Lifesciences, the structural heart peer, trades at 23 times forward earnings, close to Stryker's multiple. Both companies have dominant positions in growing procedural markets. Edwards in TAVR, structural heart repair, Stryker in robotic joint replacement. The comparison illustrates that the market prices durable procedure volume growth at the low 20s forward PE range in medical devices.
Pre-earnings options positioning for Stryker reflected cautious optimism. Implied volatility was elevated heading into Q1, with the options market pricing an approximately 4% move around earnings. The actual 1.9% decline was within expectations. Post-earnings, call activity at the 320 to 350 strikes for September expiry increased, reflecting the bull thesis that Inari charges normalize by Q3.
The September 320 to 350 call spread is the institutional trade for Stryker's recovery thesis. Buyers of this structure need Stryker to recover from the post-earnings dip and trend toward analyst price targets as Inari integration clarity emerges. The 41% consensus upside to 444 creates the theoretical underpinning for long-dated call interest.
Insider activity at Stryker. CEO Kevin Lobo and CFO Glenn Bunlane received standard equity compensation vesting in Q1 2026. No material open market purchases or sales were disclosed beyond routine equity program participation. Standard executive compensation vesting does not signal directional conviction. It is pre-scheduled and formula-driven.
The dividend trajectory supports the long thesis. Stryker has increased its dividend consistently over the past decade. At 1.09% yield, the income component is modest. Stryker is primarily a capital appreciation story. Free cash flow of $4.28 billion provides a dividend coverage ratio well above 2 times. The payout is not at risk, even if integration charges persist into 2027.
Stryker's Q1 2.6% revenue growth, 12.8% adjusted EPS miss on Inari charges, 1.9% stock decline. The miss masks the story. 0 sell ratings, 35 buys, 444 price target, 41% upside.
Mako robotic surgery is the secular growth driver. Inari charges are temporary. At 21 times forward earnings with unanimous analyst bullishness, Stryker is the medical device buy the dip of Q1 2026. Watch Mako installation growth and Inari charge normalization as the 2 key catalysts.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.